Today, we are strapping in for a high-velocity analysis on a stock that didn't just move last week.
Oh, it exploded.
It absolutely exploded. We're talking about SanDisk, ticker SNDK, and the one question that every single investor is asking right now.
Is it too late?
Exactly.
Okay.
You saw the stock surge over 27% in a single trading session. Is the party over, or was that move just the starting gun?
It was an incredible sight. And if you've been watching the market, you know which day we mean, January 6th. Stock closed right near 350.
Landed at $349.63 to be exact.
And that $75 jump, you have to put that into context. For a company of that size, that sort of single-day move is usually reserved for, you know, a takeover bid.
Or some massive paradigm-shifting announcement, and that's why the market's collective jaw just dropped. This wasn't a slow grind higher.
No, not at all.
This was a vertical spike on incredible volume, fueled by what this analysis calls an explosion of institutional buying.
And that signals the big money was finally paying attention.
Which creates the dilemma for you, the listener. Yeah. You see that huge green candle, and your first instinct is, what? I missed it.
Run. Your instinct says run because it has to crash. And our mission for this deep dive is to analyze the very compelling argument that this surge wasn't a temporary pump.
Not a frenzy.
Not at all, but a validation. A validation of a fundamental, long overdue re-rating of the entire AI storage market.
Okay, so let's unpack this. If this thesis holds, SanDisk is setting up for what the report calls a blue sky opportunity. But to understand the future, we have to look at the past.
We do.
Because the company that just ripped 27% higher is not the SanDisk most people remember.
Absolutely. The whole story changed with one critical corporate event, the spinoff from Western Digital. That was back in February 2025.
Right.
And that event was the catalyst. It was the start of a fundamental shift in their entire identity.
And for a lot of us who, grew up using their tech, SanDisk was just memory cards.
Camera cards.
Camera cards, USB sticks, the stuff you kept in a junk drawer somewhere. How do you pivot from being that company to being a massive player in the AI space?
Well, that's the brilliance of their repositioning. The analysis makes it crystal clear. They consciously shed that legacy identity.
They got away from the low-margin consumer stuff.
Completely. They moved away from that volatile consumer cyclical memory market, and they've successfully repositioned themselves almost under the radar as the backbone of the AI data center.
So we're not talking about camera cards anymore. We're talking enterprise SSDs, solid-state drives.
Yes.
Why is this specific type of drive so critical right now with the AI boom?
Okay, think of it this way. Everyone talks about NVIDIA's GPUs as the brain of the AI system, right? The processors that do the thinking.
Sure, the brains.
But a brain is useless without a constant, instantaneous flow of data. AI models need petabytes. That's millions of gigabytes of data to train.
And that data needs to be accessed incredibly fast.
Far beyond what a traditional hard drive or even a standard consumer SSD can handle.
So enterprise SSDs are specialized. They're built for scale and speed.
Precisely. They offer superior endurance, reliability, and most importantly, incredibly low latency. That's the lag time between requesting data and actually receiving it.
And that's the market SanDisk is cornering now.
Exactly. They are focused squarely on that high-end, high-margin market. They aren't selling to you and me. They're selling the essential plumbing to the hyperscalers building the AI infrastructure.
And when that fundamental shift meets this kind of market action, you get a 27% jump.
You get parabolic movement. The analysis says the immediate fuel was twofold, confirming extreme pressure. First, a classic short squeeze.
Okay, so sellers betting against the stock got trapped.
They were trapped. They were betting it would fall based on its old identity. As the price moved higher, they were forced to buy shares just to cover their positions, which adds massive upward pressure.
And that pressure combines with the second force, the FOMO chase.
The fear of missing out. Correct. When a company with strong fundamentals suddenly sees that kind of explosive move, all the momentum players and fast money jump in.
Because they're convinced a new floor has been set.
And that potent combination is what turns a strong move into a truly parabolic one. It signals a violent market reassessment.
Okay, that explains the jump. But here's the core question for me. If the company's value fundamentally changed back in February 2025, why did the big institutions wait until now? Why buy after the stock jumped $75?
That's the critical question, and it comes down to a really significant prolonged valuation gap. And that gap was driven by, well, Wall Street's inertia.
They were slow to catch on.
Very slow. Analysts were still using their old models. They were treating SanDisk like the old cyclical memory company stuck in that boom and bust cycle. They hadn't priced in its new identity.
So they were looking in the rearview mirror. What are the concrete numbers that prove this valuation gap existed, even at $350 a share?
The key metric here is the forward price to earnings, the PE ratio.
Right, how the market prices a company based on future profits.
Exactly. And even after that jump to $350, SanDisk is trading at a forward PE of roughly 22x.
And how does that compare to its new peers in the AI space?
Oh, it's night and day. It's not even close. You look at the other foundational AI hardware names, the infrastructure players, they're trading at multiples of 40x, 50x, or even higher.
Wow. So Wall Street was pricing SanDisk like a dusty library archive?
Pretty much. But its actual business model means it should be priced like the nervous system of the entire AI boom.
That is a massive difference. So the re-rating thesis is that the low PE wasn't a sign of weakness at all.
No, it was a sign of a market error, a big one. An error that is now violently correcting itself. There's still significant room for the price to rise just to catch up.
And that concept is called multiple expansion.
Correct. The stock price rises not just because earnings grow, but because the market applies a higher, more appropriate valuation multiplier to those earnings. The institutional rush was the moment they realized that 22x was just unsustainable.
And this market re-rating, it isn't happening in a vacuum. It's being validated by a huge underlying industry shift.
The memory supercycle.
The supercycle. Tell us about that.
That's the powerful tailwind here. After a long period of industry oversupply where, margins were squeezed and companies were losing money, we are now in the early innings of a major upswing in the NAND flash memory market.
And the demand is coming from the AI arms race.
Primarily. That's what's fueling it.
So what does a supercycle actually mean for SanDisk's bottom line?
It means they have regained massive pricing power. When supply is tight and demand is exploding, especially for these high-spec enterprise SSDs, prices go up.
Which translates directly to profitability.
To huge profitability. Or as the analysis puts it, they are printing cash again. And crucially, gross margins, the profit they make on every single sale, are expanding back into that 40% range.
And that 40% gross margin is key because it proves the pivot to enterprise is real and profitable.
Correct. They aren't just selling volume. They are selling high-value, high-margin components. The combination of industry pricing power and this valuation gap creates an incredibly potent engine for this bull case.
Okay, let's shift gears and look at the technicals. Because good fundamentals are one thing, but a jump like this needs chart support. The spike created a specific pattern the sources call the blue sky breakout.
Right, the blue sky breakout. This happens when a stock hits and, more importantly, surpasses its all-time high. It moves into uncharted territory.
And the significance of that is both psychological and technical.
It is. It establishes what we call zero resistance.
Okay, explain that. What is zero resistance for someone who doesn't track charts every day?
Imagine resistance as a ceiling. Let's say a stock was stuck at $200 for 5 years.
Okay.
Every time it gets back to 200, the bag holders, the people who bought at the top and watched it drop, they sell just to get their money back. That creates downward pressure.
But once you break decisively above that all-time high,
there are no prior buyers waiting to sell into the strength. There are no bag holders. The path above is technically clear. The only sellers are short-term profit takers.
So theoretically, the sky is the limit.
That's the idea. That lack of psychological overhead is a very powerful signal for momentum.
But the psychology still matters, right?
Yeah.
A 27% move in one day is terrifying to amateur investors. They're expecting an immediate crash.
And that's the hurdle. While retail traders might see that and panic, the key insight from this analysis is that smart money sees this as validation. That enormous green candle on that institutional volume, it confirms that the fundamental re-rating is absolutely real. And they are now buying into that established trend, not waiting for some hypothetical bottom.
Okay, so the institutions are confirming the thesis. We have the fundamentals. AI backbone valuation gap, super cycle. We have the technicals, blue sky breakout. Now the actionable strategy, what do you do now if you miss that jump to 350?
Discipline. It's paramount here. The analysis is very clear on this. It warns strongly against chasing the stock immediately.
So you do not chase the green candle at the open?
Absolutely not. The Relative Strength Index, or RSI, is deemed overheated.
Let's define RSI. That's key to this whole strategy.
Think of the RSI as a momentum gauge, like the speedometer on a car. It measures the velocity of the price change.
Yeah.
If the stock moved too high, too fast, the RSI goes into the overbought zone. It gets overheated. Doesn't mean the stock is bad. It just means it needs to cool down before its next leg higher.
And chasing an overheated RSI is just asking for trouble.
It's very high risk, so you wait for that technical breather.
So where is the strategic zone? Where do you look to get in?
You wait for the market to offer you a better entry. The analysis details a very specific zone, which they call the golden entry. This means watching for a sharp but shallow pullback to the $320, $330 level.
Why that range specifically?
Yeah.
Why not wait for 300?
Because that $320 to $330 range is critical. It represents the top of the previous consolidation zone just before the breakout.
Right, so old resistance becomes new support.
Exactly. In technical analysis, once a strong resistance level like that is broken, it typically flips roles and becomes powerful support. Institutions that missed the first move will often place their buy orders there at the retest of that level.
And that's the window where the recommendation is to load the boat.
That's the window. Trusting that fundamental re-rating thesis.
Wait for the dip and then commit heavily. That takes a lot of conviction in that $420 price target.
It does. It requires extreme discipline, but the conviction is rooted in the long-term outlook. The analysis calls SanDisk the NVIDIA of storage.
That's a powerful analogy.
It is. It signals its essential, non-negotiable role in the entire AI ecosystem. And based on margin expansion and projected AI demand, they set that aggressive price target of $420 by mid-year 2026.
Labeling 2026 as the year of storage.
The year of storage, the time when these previously ignored components finally catch the attention of the wider market.
Okay, so to synthesize this for you, the listener, we are looking at a company that is fundamentally transformed. Its massive move was justified not by hype, but by an aggressive institutional validation of its new identity. As an enterprise SSD and AI data center backbone, the market is finally correcting a massive valuation gap.
And crucially, the strategy is all about patience and precision.
Do not chase the momentum now. Wait for that specific pullback zone, that $320 to $330 window, to enter. That allows you to capitalize on the shift without taking on that unnecessary short-term risk.
So what's the final implication here? If SanDisk's move validates the thesis that these crucial, often overlooked components like high-speed storage are due for a huge re-rating because of AI, what does that tell us about the broader market?
It tells us that the definition of an AI stock is expanding rapidly.
Beyond just the chip makers. Exactly. We've seen the processors run, but the ecosystem is vast. If SanDisk's validation is a signal that all the infrastructure builders, the connectivity providers, the cooling experts, the power management companies are all sitting on similarly undervalued multiples, it means we could be entering a whole secondary phase of the AI boom.
A phase where the physical foundations finally get their financial due.
That's it. The validation of SanDisk suggests the smart money is now moving down the supply chain. They're looking for the next essential component that's been mispriced. The question you should be asking yourself is, which other underlying infrastructure companies are still trading like a dusty memory card manufacturer when they are, in fact, the essential plumbing for the AI future? That's the theme worth exploring next.